Welcome to Global Insights with me, Punita Kumar Sinha. In this episode, we will discuss the ongoing bull market rally in two key economies, the US and India. Both are at different stages of the economic cycle, and yet both these markets have witnessed a historic rally over the last 18 months. What are the driving factors and how much steam is there left in this run? Sriram Iyer with this report.
Year 2014, the stars aligned in a way that fortunes were made, both on Wall Street as well as Dalal Street. Equity indices are at levels never seen before in both these markets. Even as dollar moves from strength to strength, the rupee hasn't bowed out yet. Green shoots seen in the American economy in 2009-10 have now become shrubs. And given the troubles on European soil and a Japan in turmoil, global money has preferred the safety of America. Across seas, investors had accounted for an improvement in India's macroeconomic cues in late 2013. But it was the decisive change in leadership in May 2014 that reignited faith in New Delhi. And the Indian dream to be a global economic power was alive once again. If US is the safer bet among developed economies, India is the only shining light among BRIC nations. But in a turbulent world, can isolated patches retain their strength? Will the clouds of gloom emanating from Europe dampen the American sentiment too? China is on a path of calibrated slowdown. But if the safety net snaps, can India sustain the rally on its own? Or does this rally have more legs to run with?
Certainly, there is no lack of confidence in both these markets. But do the fundamentals, both at the local and global level, support the market sentiment? To discuss this, we have two guests, both joining us from New York. Prakash Melwani, Senior Managing Director and Chief Investment Officer of Blackstone Private Equity, and Krishna Memani, Chief Investment Officer at Oppenheimer Funds, who oversees $240 billion. Thank you both for joining in. Let's start with a rally in the US. Coming to you, Prakash, how do you rate the strength of the US economy based on what you're seeing from the companies you invest in?
Well, Punita, as you know, Blackstone has a large number of companies in the United States. I think we have something like 70 companies in our portfolio right now, 80 plus billion of revenues. So it gives us a very good window into the U.S. economy. And frankly, we track early indicators from those portfolio companies to get a read about what's going on with the economy. And right now, we see continued progress in terms of economic growth. Sometime in the middle of 2013, we saw a real pickup in performance. And so I would say that has continued. Many of our companies are growing their top line at 5 to 6%, and their operating profits are growing at close to double digits or slightly over double digits, depending on the quarter. So I think the sort of overall macro numbers of 2.5 to 3% mask some real underlying strength in many parts of corporate America. And I don't see anything changing in that regard going forward.
That sounds very positive. But are you confident that earnings can sustain even as QE has ended and interest rates can rise?
Well, I think there's a lot of variables that could affect that. But I think most of those variables are exogenous to the United States. I think you could obviously import slower growth from Europe and China. But I'm not overly worried about interest rates being the cause of slower growth in the United States. I think the Fed under Yellen has made quite clear that they're only going to be raising interest rates when they see demonstrable, solid foundation for the U.S. economy. And so I think higher rates will come after you've got really sustained growth, and I think it will continue to lag behind the growth progress in the economy. So I'm not worried about higher rates derailing the economy. My biggest concerns are actually, frankly, from outside of the U.S.
Krishna, coming to you from a market standpoint, US has rallied, but investors are divided between believers and non-believers. Which camp are you in?
So I think the markets are definitely divided between people, the believers and non-believers. But at the end of the day, I think the non-believers are turning into believers as well. The driver really is, policy support, and as a result of the policy support, economic growth has come back. It's not at the pace you would like it to be. It's not as stable. It's still very fragile, but it's 3%, which is higher than any other developed market out there.
And like Prakash, do you also think the growth numbers can sustain?
I think you have decent income growth, you have good employment, and as a result, decent income growth, and therefore consumption is relatively stable, and capital spending is quite stable and improving. So off of that, I think we can look forward to good growth. Whether that would be significantly above 3% or not, we can debate.
Prakash, from what I'm seeing, it appears that most companies in the US are seeing growth coming from the US, but not from Europe or other countries. Is that correct?
Well, there's definitely signs of a slowdown in Europe. If you look at the overall Eurozone, it's expecting 0 to 1% growth this year. But the thing that's really troubling is what's going on in Germany. Germany has never weaned itself from being an export economy. And as China has slowed down and as it's reduced its trade with Russia, Germany is really slowing down, so it's going to grow at about 1% this year. And if that's the locomotive of European growth, that's a problem. We're seeing the same things in China, frankly, and it's very hard to really put real weight behind the sort of macroeconomic statistics you get out of China. But from all the various indicators we're seeing, electricity consumption, steel consumption, China is slowing down markedly, and that is also being exported to Europe and the U.S.
In that case, don't you worry that the slowdown in Europe and the rest of the world could bring U.S. growth down?
Well, I think it'll bring U.S. growth down at the margin. So I think next year's growth will be in the 2.5% to 3% range. But don't forget, many developed countries have just had a massive tax cut through the fall in the price of oil. And whether it's the U.S. or India, at the end of the day, the decline in oil prices at almost 25% from the recent peak is a real windfall to consumers in our economies. And so I think that's also going to be a tailwind that offsets some of these deflationary forces that are coming from other countries. So I'm not by any means thinking that we're going to slide into any kind of recession or even come close to it in the U.S. I think it's just going to be slow and steady, 2.5% to 3% real GDP growth for the next year or two.
And Prakash, how much of the growth in the U.S. is coming from the stimulus versus a real recovery?
That's a really interesting question. So I think there's a lot of different things going on. I think there's a subsegment of the consumer in the United States that has been really affected by technology, whether they've lost their jobs and have been displaced, or whether technology is putting a cap on their real earnings, or whether they just don't have the skills to get jobs. And so you've got this sort of structural unemployment that's been built into the system. And I think when you look at many companies that are serving the lower end consumer, companies like Walmart, they're seeing distress in their consumer base. But I think it's an economy that's running at two speeds. There are many segments of the consumer, especially those that are employed, those that are higher income, that are doing quite well. And so I think you've got to be careful. I don't think you can generalize about the U.S. consumer right now.
But from what you see, is it top-line growth that is driving earnings in the U.S., or is it productivity gains and cost containment?
Well, it's interesting. We take a survey of our CEOs every quarter, and look, one of the reasons profitability has been so good in the United States since 2010-11 is, frankly, companies have been able to do more with less. In other words, they've been able to increase their productivity, manage through technology and capital spending to essentially produce more with the same workforce, and that's shown up in higher profit margins. Profit margins are near or at an all-time high in the United States, and that's part of the reason the stock market's so high. So companies have resisted hiring to a very large extent. At some point, that has to end, and I think as confidence has returned to many companies that this recovery is for real, people are starting to hire. So our CEO surveys have shown in the last 2 quarters a real change in the intention to hire. And I think that's showing up in some of the macro statistics in terms of falling unemployment rates.
Krishna, coming back to you, the market has been a stellar story, but what about the underlying fundamentals? The US is looking at higher rates and a stronger dollar, which could impact export-led earnings.
So that is going to be a challenge for a lot of the multinationals in the U.S. That is, from a reported earnings standpoint, the currency conversion will definitely would be a headwind that they face. But the rest of the U.S. economy is in a significantly better footing than where we were a few years ago. So as a result, I think you have enough support. Whether that can get us to significantly higher levels calls for either growth or equity market valuations, I think is a fair question to ask. We are looking for maybe high single digit type returns out of the equity markets, and in the current environment, I think looking for significant improvement above and beyond that is probably unrealistic for the things that you point out.
So have there been any structural changes that will help the U.S. markets?
So the structural changes have been quite significant. If you look at our profitability growth, the profitability growth of U.S. companies has been spectacular. Actually, without a significant amount of underlying economic growth, they have been able to deliver very, very meaningful profitability growth.
Prakash, turning to valuations, what do you think of the ridiculous valuations some of the M&A deals are happening at, particularly in the tech sector?
Yeah, I've looked at a bunch of them. Look, it depends what you define as ridiculous. For a strategic acquirer who's having a hard time getting the kind of top-line growth that they'd like, doing an M&A deal where there's cost synergies or other synergies can be very, very accretive, especially if your cost of capital is near to zero. Many companies today can borrow in low single-digit interest rates, and almost any deal they do is accretive from an earnings per share perspective. So I've seen some actually quite sensible deals done. The headline multiples are high, but when you take into account the operating benefits the companies get combined with the financial synergies, I think a lot of these deals are actually quite smart deals.
Prakash, do you see any risks of asset bubbles in the U.S. like we've seen in the past whenever we've had a strong rally?
I'm not worried about sort of systemic risk in terms of financial institutions. I think the focus that has been put on the balance sheets of those financial institutions has been extraordinary. I think the regulatory environment has been, quite stringent, and so I'm not worried about systemic risk. It's very hard to define what a bubble is, but are there signs of froth in the debt markets? In art markets, in certain real estate markets, especially the luxury end, yes, there's signs of a lot of froth, and those are classic signs when that maybe the markets are vulnerable. But again, it's very, very hard to know what the catalyst for what will eventually bring things down, especially when you have a Fed that's basically made it clear it's going to be accommodative for a long time to come.
It's time for a short break. Both Prakash and Krishna believe that corporate America is strong, and if it sustains, the overall US GDP could grow a lot faster. They don't seem worried about rising interest rates in the US. We will take this discussion forward. We will also discuss the fundamentals of the Indian economy. Is it strong enough to sustain the market momentum? That and much more when we come back. Stay tuned to ET Now. Welcome back. We've discussed the strength of the rally on Wall Street. But what about India, which also has seen a spectacular rally this year? Foreign institutional investors have pumped in over $15 billion into India so far. Has the Indian economy turned a corner? Krishna, let me start with you. From a market standpoint, is India one of your preferred economies?
Oh, absolutely. I think the picture in India has changed dramatically over the last 12 months. I think India has all the ingredients of being a really good, solid growth story globally for the next year or for the next 5 years. They have a political mandate to go out and restructure the economy, and they have a central bank that is with a new governor has kind of earned their credibility in the marketplace, both domestically and overseas. So I think all the raw ingredients are there. The question and the challenge for Indian policymakers is to actually execute.
Prakash, based on your experience as a private equity investor, how soon do you see U.S. companies starting to invest in India?
I think there's a real appetite for U.S. companies and U.S. investors such as Blackstone to invest in India. As you know, Punita, we've been probably the most active private equity investor in India in the last 5 to 10 years. We have about $2.9 billion of investments across our private equity and real estate businesses. So obviously, many companies like ours are believers in India. But really, India has made it hard for U.S. companies and U.S. investors such as ourselves to invest there. And frankly, if India would just, in some ways, get out of its own way, there is a real appetite for American capital to come there. And I see it all the time. When I meet with our pension fund investors, they really want exposure to emerging markets. And you think about the BRICS. You've got Russia today in disarray. You've got China slowing down markedly. You've just had an election in Brazil, which was many business leaders feel was not business friendly. And so India is really the shining light amongst the BRICS. And so if Prime Minister Modi can fulfill at least even half of what people expect from him, I think you'll see a big increase in investment in India.
Right. So what do you think are the institutional challenges that need to be addressed urgently for strategic and private equity capital to come to India?
Well, it's a long list, but I would say the following. I think the Indian bureaucrats have never worked out that, in order to attract capital, you've also got to allow capital to leave. And so I think they say, well, we want to attract capital, but let's make sure if they want to leave, it's hard to get out. And so they don't understand that basically reduces the willingness of free capital, which can go anywhere in the world, to come into India. So I'll give you examples of that. The flip-flop on tax laws that happened a year and a half ago, where they were going to do retroactive tax changes to 1962 or something like that. At the end of the day, bad policy is one thing. There's only one thing worse than bad policy. It's bad policy that's implemented retroactively. And so that's the ultimate bad thing for capital, because if you know there's a bad policy, you can decide, okay, I'm not going to go there. If you go to a country based on a certain premise and then they retroactively change laws and change policies, that's ultimately the worst thing for capital and keeps capital away. So some sort of clarity on the tax regime and stability in the tax regime, with Mauritius and other places, so capital knows what it's going to be taxed at. We can then make our own intelligent decisions of whether we want to come or go. Other examples of where it's quite hard to make investments into India. The FIPB approval process is a very slow one. It takes a long time. It's relatively opaque. It shouldn't be that hard. With regard to the stock exchanges, it's very hard to take a company public in India. The SEBI processes are very, very slow. When we invest in companies in India, in private companies, we want to know that there's an opportunity to eventually take those companies public. That's a win for India, okay? It's capital formation. It shouldn't be that difficult. Similarly, if we have a stake in a public company and we want to sell it to a big American or Japanese or other strategic acquirer, it shouldn't be impossible for those companies to take those companies private. Right now, they can buy out a Blackstone stake in the company, but speculators can come in, buy a small position in the public company, and block that public company from ever going private. And that's bad for a strategic M&A into India. So I would say there are a lot of things that India has done to make it very, very difficult to attract capital into India. And if the government can just focus on making India a little bit more business friendly, it will find that capital really wants to come there.
And do you believe that India can succeed in the Make in India effort in the manufacturing sector?
Oh, I think absolutely. I mean, the Indian entrepreneurs are very bright. The currency is very competitive. We own a company called Agile, which makes motors, and it exports them to automotive manufacturers all over Europe and the U.S. And it's extremely competitive. It's got a leading market position. There is no reason at all why India cannot be a leading manufacturing center globally. And I think it's a terrific initiative by the Modi government.
Prakash, now Blackstone has invested significant capital in the power sector. What do you think of the coal denationalization?
At some point, there's just been so much noise around this sector that I think it's in the category of is life too short. At the end of the day, I think if there is real clarity by the government about how the sector is going to be operated and what the rules of engagement are, and that those rules will not change, I think foreign capital would definitely be attracted. And India could really benefit from it. India is a coal importer when we have lots of coal reserves. We're power short, and coal would be a primary source of that power. And so we should be doing everything we can to supplement the production of coal in India. But I think, again, there's been just so much of a cloud over the coal mining sector that I'm not sure that foreign capital, unless there's much more clarity, will be willing to take the risk.
And Krishna, where would you invest, India or the US?
So I think from a long-term perspective, both of these countries represent really good value. The challenge for the U.S. is, given the size of the economy, given the structure, and given the deleveraging that still needs to take place, the growth trajectory for the next, let's say, 10 years is probably more subdued than it has been in the past. And as a result, as a U.S.-based investor, you are always on the lookout for good growth opportunities overseas. China used to be a story for both from a portfolio and FDI standpoint, and I think that is transitioning. If India can deliver, I think India would be the biggest destination of U.S. flows over the next 5-10 years. They just have to deliver.
And Prakash, it seems like you like growth in India and the US as well. But how do you compare the valuations of both countries?
So it's really interesting. I don't think U.S. growth is going to be very strong. As I said, it's going to be 2.5% to 3%. That's plenty strong enough for individual companies to do quite well. Both the U.S. and India stock markets trade at about 16 times earnings. India's got a real GDP growth rate that's almost, well, actually more than double the U.S. growth rate. So India is supposed to grow at around 6%, maybe 6.5% a year from now. The U.S. is half that. And we both trade at the same PE multiple. So I think at the end of the day, I think, India could be quite an exciting place for capital. And that PE multiple I just talked about, the 16 times for India, assumes no step change in the E, the earnings part of it. Again, if India can just do some of the basic things in terms of getting out of its own way, less bureaucracy, more clarity about rules, less corruption, I think you will see potentially a step change in the E part of the PE.
And what do you see as the key risks for India then?
I think the biggest risk for India is not living up to the promises and the hopes of the new government. At the end of the day, I think there's when I had the pleasure of meeting Prime Minister Modi when he was here, and he made a very big impression on his trip to the United States. And I think expectations are high. I think people are realistic. People understand that things are not going to change overnight. But if those expectations are missed by a wide degree, I think that will be a real disappointment. If a government with this kind of mandate cannot make changes to the bureaucracy and to corruption, I don't know what kind of government will be able to.
And Krishna, what is your assessment? Do you see any risk for US and India that could derail the bull market?
I think both U.S. and India will not be immune to that. So you see a bit of that going on right now. For example, inflation expectations in the U.S. have come down a meaningful amount. They had been stable for the longest time, and they're down meaningfully since the end of the summer. I hope ECB and the Bank of Japan and policymakers in China are able to kind of arrest that disease, that deflationary disease. If they are not, despite the fact that both U.S. and India are more of a closed economy, and I think we wouldn't be immune to what happens in the rest of the world.
Prakash, finally, last question for you. Do you agree that India and the U.S. are the two best investment stories in the world today?
I think the growth story in the U.S. and India are particularly exciting, but there are interesting investment opportunities that will come out of the slower growth in Europe and China.
The message is very clear from the foreign investors. US and India remain two of the best investment destinations for now. So far as India is concerned, even after the recent rally, they do not find the valuation stretched. Continued government focus on reforms and execution can unlock further value for investors. That's it on this episode. Thank you for watching. Do come back for the next episode of Global Insights with me, Punita Kumar Sinha, only on ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.